And we are back. It is week 3 of Mortgage Market Movers Weekly, and we are being consistent, doing this on a weekly basis. So let's keep each other accountable. All right. We have a special guest today for you. The official mascot for Mortgages by Linda, Milo, is here to say hello. Hey. All right. In case you didn't know, this is Milo. He is the official mascot for Mortgages by Linda, and he wanted to make a special appearance. All right. Well, he has important business meetings to attend to, so he's going to run long. We had a huge week last week. Really big things happened in the market, okay? Particularly towards the end of the week, so we're going to go over that. In case you don't have the attention span, it's not a TikTok, so it's not 15 seconds long, right? It's a 10-minute long video. I get it. You don't want to watch the whole thing. Interest rates have come down a little bit. The average 30-year is around 6.95, right? That is up from, I believe it was 7.04 last week. So weekly ticking down. A lot of volatility in the market, though, last week, particularly at the end of the week. So it's looking like things going to get a little crazy. Interest rates might start ticking up, but we are going to look at the possibility of that. We're going to look at what happened, and we are going to chart a path forward. So let's take a look at the charts. All right, and we are over at the charts, right? So we are back at the U.S. 10-year Treasury yield. So if this is your first time tuning in, the U.S. 10-year is a very good proxy for mortgage interest rates. This is not what the interest rate is. However, this is going to tell us if interest rates are coming up or coming down. We are on a daily chart, so this is daily what it's looking like. And as you can see, interest rates have been climbing, little pullback, climbing, pullback. So we are in this pullback right here. What we don't want to happen is the interest rate to get up here to 5%, while the U.S. 10-year yield to get up to 5%. Interest rates are going to get pretty high. Just for a reference, if it did get up to 5%, that is roughly what interest rates were looking at like back in 2023 of October. And let's just do a quick comparison, right? Okay, let's go over here. October 2023. Looks like at its peak, 7.79% was the average rate for a 30-year fixed in October of 2023. To compare that to today, I said in the intro 6.94, so forgive me, it's actually 6.95 is the average interest rate, and we are looking weekly to see the trends, right? So that is almost 1% higher, right? If it gets up to the 5% level. We do not want that. We want lower rates, okay? Speaking of wanting lower rates, so last week we had big things happen. Let's go over to here. We're going to go to our economic calendar. So the federal funds rate, this is the interest rate set by the Federal Reserve, 4.5%. Markets had been pretty optimistic lately that the Fed was going to cut interest rates up until December 18th, I want to say, when Jerome Powell, who's the chairman of the Fed, came out and said, we don't really have good reason to cut rates too much. The market was pricing in 4 interest rate cuts. Jerome Powell said you might get 2. Inflation was not getting down to their neutral rate of 2%. Inflation is currently sitting around 2.8% year over year. It has not been coming down, so the Fed has no reason to cut rates. Because of that, the market has kind of been in this weird phase of wanting interest rate cuts and looking at the relationship between the unemployment and inflation, right? So when unemployment is doing well and inflation is also ticking up, the Fed has no reason to cut rates, but they do have a reason to do a rate hike or pause rates, which is making investors in the market fearful. Whenever the market is uncertain, the U.S. 10-year yield tends to climb because the incentive for the 10-year yield, the reason that it climbs is because bonds are dropping down low. I think I just got a little cutout in audio. So if you hear a little cut in audio, my apologies. Faulty equipment, technical difficulties. So that's what happened. We had that meeting Wednesday, January 29th, where Powell came out and said that we are going to pause rates, which is what the market was expecting. So nothing really happened there. It was a really good meeting. The week prior, I believe it was, Trump spoke at the World Economic Forum and said, I want lower interest rates, as do we all. But Trump has no authority over the central bank, the Federal Reserve, and Powell had a very... He wanted to take himself out of any kind of political arena and say he did not want to comment on that. You know, he could have come out and say, no, we're actually going to do a rate hike to kind of demonstrate the autonomy of the Federal Reserve. He did not do that. He did what he believed to be best, I'm assuming, and kept rates paused. So that was a good thing for the market. That's what was anticipated. Okay. Then we got in unemployment claims. They came in a little lower, which is good. We also got pending home sales month over month. This number is interesting. So if we look at what pending home sales are, it's the change in the number of homes that are under contract but have not closed yet. This does not include new construction. This came down by 5.5%. And if we look historically, since October of 2024, they had been coming up 7.4%, 2%, 2.2%, and this is month over month, so it's comparing from the previous month, okay? So from January to December, the number of homes under contract that are waiting to close has decreased by 5.5%. It looks like that might be a sign that inventory is sitting a little longer, which makes sense. If we have inflation concerns, people may want to hold off on spending their money, right? It's a little bit of an uncertain market. So that is what we had from the economic calendar. Now, Friday, the big bad T word was said, tariffs. Okay. Let's go back over to the charts. Let me pull up. Okay, we are going to go. Let's look at this is the overall, this is the S&P 500. If you don't know about stocks, it's fine. This is a good index for the overall stock market. The stock market is related to the U.S. 10-year yield. As the stock market rallies and goes up higher, typically the 10-year will fall and vice versa. They are inversely correlated. Whenever investors are getting spooked, they pull money out of the stock market. They also pull money out of the bond market. As inflation ticks up, people don't want to have their money in the bond market because what a bond is an IOU, of course. So if inflation's high, your buying power decreases over time. If it's in a bond, you can't access that. So your $1,000, your $100 is not going to be the same today as it will be in 20 years if we have inflation. That's why high rates are incentives for investors to have their money in bonds. And that's part of the reason that the U.S. 10-year ticks up, right? So, all right, let's not get too technical. Now, on Friday, what happened? We can zoom in a little bit. This huge drop, these red bars are all drops in the stock market. Friday, it was a pretty calm day, little sideways. The market started going up. This was almost an all-time high in the stock market. And around 1 p.m., it was either 1 or 2 p.m. on Friday afternoon, it was revealed in a memo. I want to say memo, maybe a press conference, maybe a tweet from Donald Trump. I'm not sure. But it was disclosed that tariffs are coming, and they are coming in hot. Okay. 25% tariff on Mexico, 25% tariff on Canada, 10% on Canadian oil, and 10% tariffs on China. That is definitely going to happen. And the plan was for it to happen on this last Saturday, which I believe it did. Investors were completely spooked and scared, and they said, we want our money out of here. Okay. They pulled their money out, and the market dropped like crazy. Okay. So let's compare that to the US 10-year. Big spike. Big spike. And then it came down around 4. Looks like the market started to calm down a little bit. Okay. But big spike. Now, tariffs, trade wars, this is going to bring a lot of uncertainty to the market. What's going to happen? We really don't know. It's really a volatile market, and that's what I was saying in the intro. Right now, volatility is kind of the name of the game. Is the U.S. 10-year going to climb back up to 5%? Maybe. It's just so volatile right now. We see these huge drops, right? This was just in one day. And luckily, Friday, it wasn't too bad. We saw when we zoomed in on the day that the U.S. 10-year climbed up, but then it dropped down significantly. Is it going to get back up to 5%? We really hope not. But if inflation starts coming up and the market is scared and they want to pull their money out, that will cause the 10-year to go up. Now let's just look real quick. Okay. And we are comparing the bond market, this blue line, with the US 10-year yield. Okay. Again, inversely correlated. So as the bond market comes up, we're going to see a drop in the US 10-year. This is starting to come down in the bond market right here. Okay. People are pulling their money out. Investors are getting a little bit more optimistic, and that is why the 10-year is starting to fall right around here. Investors are okay. They don't have too many concerns about inflation, and then it comes back up. So that is what's going on with the rates right now, and the big event that happened Friday. Essentially, Trump confirmed that tariffs are coming, and they are coming in hot. Okay, so let's go back over here. And what do we have next week coming up? Anything crazy? We do have a lot of data. We have employment change. We have the unemployment rate. We have... I don't believe that there's too much. No, there are some things in here. PMI. This is the Purchasing Managers Index. So it is looking from the purchasing manager side of any manufacturing to see on the services level, are prices increasing? So this is a proxy for inflation. So this could potentially, if inflation is coming up a good bit higher on the services side, this could spook the market a little bit. So that's something to look out for. Unemployment claims, it's always good to check those out. And unemployment claims have been falling. And it's not that we want unemployment claims to rise up like crazy. However, there's a really weird relationship right now between unemployment and inflation, where if unemployment gets too low and inflation gets too high, rate hikes are back on the table for the Federal Reserve. And when we say rate hikes, we mean bank interest rate hikes. That is really not great for the market. That is probably going to scare a lot of investors and have investors go into less risky investments, i.e., get out of the market, probably get out of bonds too. Could raise the U.S. 10-year yield. That's definitely something to look out for. Anything else? Like I said, looks like interest rates have been coming down. January 16th, we had a little spike here. 7.04 was the average weekly, and it is coming down a little bit. We can look at this graph, actually. Let's look monthly. So monthly, they've been coming up, and we see that with fears of inflation. And really, it's like I said, it's just so volatile right now. So we have to wait. We have to wait and see. We don't want to get back up to this. Remember, I said October 2023. That's around where that 5% for the U.S. 10-year yield was. 7.62. We don't want to get up there. Okay. So that's all I have for you guys this week. We will keep an eye out. We got to see what's going on with the tariffs. We got to see how long will this last. What are the trade wars going to look like? I do know that Canada, Justin Trudeau's prime minister, I believe he is, he had a response to the tariffs, and it looks like there's going to be, counter tariffs put on place. I believe Mexico also has some counter tariffs. So we got to see. There's a lot of uncertainty in the market. We just really need to see what's going on, okay? So we are going to keep our eyes open and our ears open to see what's going on. We will be here every week to let you know what's going on in the market. Are interest rates expected to go up, go down? In conclusion, it's looking like they could tick up, okay? So if you are wanting to purchase a home, it might not be a bad time right now. You can always refinance later if they happen to come down. Is that big of a deal? Not really. You get your loan extended, right? But usually, at least with Mortgages by Linda, we structure it where you aren't really bringing much money to the table. You might have to pay for an appraisal, but that might not even be the case. You can always refinance, okay? If the interest rates drop, you can always refinance. But if you buy a house, let's say you buy a house for $300,000, if it goes up to $500,000, right? You can't refinance the purchase price of that. Okay, so that is gonna be it for this week. If you have any questions, comments, or concerns, feel free to comment. Give us a call. 877-TEAM-MBL is where you can reach us, or www.mortgagesbylinda.com. Let me know how I did in the comments section. Do you want anything explained more? Did I misrepresent something? Do you know better than me and I don't know what I'm talking about? Let me know. For real, that was not sarcasm. I'm always looking to learn. So we're going to call it for this week. All right, you guys have a great week and stay safe out there.